APV, where we have foreign operations, advanced investment, foreign operations, and also options. The use of options are all under what advanced investment appraiser, right? And I believe if they are going to set question on advanced investment appraiser, it's going to be under those three variants. So by the time I cover options today, we'll still solve another question, because option will be a question that will be that will be under advanced investment appraiser. So we're solving another advanced investment appraiser today, and which I've sent to the WhatsApp. You will see it on the WhatsApp this thing. I guess the question is Chumra, right? Chumra. So you can open that. You can open that and you can be reading it by the time we start. So we'll be looking at options today, and we'll be solving a question related to options, right? So that's advanced investment appraiser, which I have covered, like those three variants. And I made sure I brought out questions that I know that okay, the scope of the studies would be within those questions. It might not be more than that. It won't be more than that normally, because it was comprehensive questions I solved. So, but I still owe you one advanced investment. I still owe you one advanced investment appraiser question, which is APV. I don't know why my spirit is going to APV this diet, right? So I want to solve one more advanced investment appraiser question on APV before Saturday, right? Which is comprehensive, a 50 marks question on APV. So by the time I'm done with that, I know that advanced investment appraiser, I am done with you on advanced investment appraiser, right? That means we've been able to solve like 4 to 5 questions, which is okay for what under a tutorial sense of view, right? And others, you just need to go and practice yourself and solve more questions yourself. Under merger and acquisition, we were able to solve I think we solved only one question, right? The first time I had with you. So, and I told you that I have 3 other variants to share with you, right? Which we are going to solve within this Wednesday, Thursday. No, that will be tomorrow, Thursday, Friday, and Saturday. So we're going to solve 3 questions under mergers and acquisition. 350 marks questions. So you have to prepare your mind, because it's going to be a long stretch. By the time I'm done with those 3 questions, I'm telling you, there's no merger and acquisition question that you face that you would be scared of. You would go there with boldness, because there is nothing they want to give you that you will not be able to tackle. And the third one, so I've talked about investment decision, right? The dividend decision part, we've been able to establish that last week, which we took our time to solve 2 questions, right? We solved 2 questions where we solved Chitros and Autoco, and there was a note also that we had a long conversation on dividend issues, right? When it comes to the types of dividend policy and also other things that are involved in that, we have done that. So I believe it won't be more than that. So we've covered that part. And lastly, so we have 4 variants. We have investment, we have financing. So we have dividend, we have risk management. Risk management was handled by Emmanuel. So I believe he has done justice to that part. So that's the third one. I think the last part that is remaining is financing, right? And that financing is not really a lot. We've done a part of financing. The part of financing that we did was bond. We did bond valuation, if you remember vividly. I took a whole class on bond valuation, right?
Yeah.
And normally in
Yes.
bond valuation question, bond valuation is not usually on its own. It's embedded into a question, maybe an advanced investment question or something. So one of the advanced investment, one of the maybe merger and acquisition question I'll be solving next, we're going to see a variant of bond where we'll be applying those bond related conversation we had the last time. So I carefully pick those questions so that you can understand that. And if time permits me, I would we're going to discuss debt issues and equity issues, right? Those are conversation parts. They're not calculations. Those conversation.
Okay.
Sure, you understand. Debt issues, types of debt that you can raise. Also equity, how you can raise equity. Is it IPO? Is it placement or the like? So we're going to have that conversation. Those are those conversations we have on Saturday as my closing remark for you, right? On Saturday, please remind me we are going to have that on Saturday. And lastly, I want you to go and read this on your own. I may not have time to take that one. I always advise
No,
students go and
it's
read that
fine.
on your
It's
own.
fine. It's
Um,
fine.
so that's no, I'm not talking about the equity and debt. I'm going to discuss that one with you, right? The last
Okay.
one I'm talking about that you read on your own is behavioral finance, right?
Okay. Yeah.
Behavioral finance. Go and read that one on your own. Just have a view. That one is just have an understanding of what behavioral finance is and all the terms in behavioral finance. And lastly, you also read this one. The part where we have all these OECD countries, World Trade Organization, all those things are now bilateral trade, multilateral trade, all those things is not something I should be sharing with you in class. It's something you can just read on your own. So those read those parts, all those World Trade Organization, all those OECD countries, blah blah blah. To be honest with you, and the thing came out in my own time. I wasn't expecting it. I didn't, those things we did them in commerce in school then and all those things. So I wasn't expecting that to come out. So I didn't really read it. I just brushed through it. But man, it came out as like, it's not a 15 marks question. It came out as a 15 marks question. I swear during that exam. Because though I had a faint idea of what those things are, but because I didn't read it in the textbook, so I was struggling. I was using my common sense to solve them. You understand? So when you use common sense, sometimes your
Yes.
confidence level is low, but you're just trying your best so that at
Yes.
least worst case you will not fail. You understand? At least they will give you 1 or 2 marks there, right? So please don't like I said, the two I want you to go and read on your own. Those multilateral organization, those OECD countries, blah blah blah, and behavioral finance. Please go and read those two on your own. Go and read those two on your own. And like I said, based on what I've discussed, I'm going to be doing those parts. So by the time I'm done with the ones I've promised you, I know I've covered investing side of finance management. I've covered financing side, and I've covered dividend side. And Emmanuel would have covered the risk management part. So I think
Risk
we are done.
management.
Yes, because Emmanuel is handling that risk management part. That's where he's handling and the corporate reconstruction with you. So with that, I think we're fine. And God knows that we've tried to some extent, and we trust God for you to
Yeah.
excel in the exam. Yeah. All right. So let's move on to option pricing. So as you can see it on my screen, confirm that you can see my screen, please.
Yes, I can.
All right. So what is option, right? I know you've had those classes with Manuel, but let's just brush ourselves again and be familiar with the terminologies, right? Option is a contract giving one party the right, but not the obligation. So it's not an obligation. You have a right. You are not forced to. It's a different thing. Like when you have a forward or a future contract, future or forward contract are what there's an obligation, right, binding on you. But the beauty about option is that you have the right to walk away, right? So it's not compulsory that I must do it by fire by force, right? It's not compulsory that if this thing is going to go against me, right? I have the choice to say no, I'm not more interested. But in a future and forward contract, it is binding that you must fulfill the obligation. So the beauty about option is that, but the flip side about option is that there's an option, there's a cost, right? If you remember, there's usually a cost that you pay, right, to enjoy the benefit of option. That's what makes it maybe more expensive sometimes than the others. Because why? There's an embedded cost in it. Because benefit you're enjoying to run away from a risk crystallizing, there's also a cost embedded in it, which is what I think we call it option premium, right? If I remember vividly, it's called the option premium, right? Yeah. To so is what is a contract which gives one party the right but not the obligation to buy or sell an underlying asset, right? And at an agreed price on or before a specified date, which is the expiry date. So the purchaser or holder of the option can either exercise their right or let it lapse. That is what I said. You can either exercise it or what?
Let it start.
Or let it what? Or let it lapse.
Hello? Are you there? Hello? Hello?
Hello, Z. Can you hear me, please?
I lost you for a second.
Yeah, apologies. Is this Is my regular network. I just pray it doesn't give us issues. All right. So please confirm that you can see my screen.
Yes, I can.
All right. So like I said, so that's that about option. Now we now move to, so we have what, either a call option or a what, or a put option, right? And in the
Yeah.
call option, it gives you what, the right to what, to buy the what, to underlying
Right.
asset. And if you remember, based on what Emmanuel taught you, it will be more of call option, right? If you notice, it's more
Yes.
of call, yeah, call, because we don't really do sell, right? Like, so it gives you what, the right to what, to buy the underlying asset. And what about put option? An option that gives the right what, to sell the what, underlying assets. What is exercise or strike price? The price at which the underlying assets can be bought or sold when exercising what, the option. So that's the price. The strike price is the price at which the underlying assets can be bought or sold when you are exercising what, the option. What is now option premium? Like I said before, the amount the purchaser must pay to buy the option. So that's the embedded cost, also refers to as the option price. The premium must not be confused with the exercise price. So please note, I believe you know this, so you've done options. So it's what, the premium must not be confused with the what, with the exercise price. In a perfect market, it should represent what, the value of the what, of the option. Now, what is writer? We have some other terminologies like writer. The seller of an option who receives what, the premium. So the seller is the seller, the writer is the what, seller of an option who receives the premium. We now have different types of option. We have the European style and we have what, the American style. What is the European style? Option which can only be exercised on the what, expiry date, while American US style is what, which can be exercised at any time before what, and on the what, expiry date. Most times I think mostly adopted style is the what, is the European style, which can only be exercised on the what, on the expiry date. Now we now also add other ones like mid-Atlantic Bermuda options which can be exercised on any one of a preset series of dates. So you have different dates, you can now exercise it at any of those what, preset series of dates. So maybe you have 8th of May, maybe you have 10th of May, maybe you have 15th of May. Any of those 3 dates, you can what, you can exercise it. So those are the what, different types of what, of options. Is that clear?
Yes. Yes.
Yeah, let's move on. Thank you. So we now have what, we have exchange traded listed options. And what are exchange traded listed options? Any options what, contract listed on the public what, trading exchange. So an exchange traded listed option is an example of a future contract. You know, the difference between a future and forward is that one is what, on a proper exchange, and the other is what, on like in an informal setting. Forward is an informal setting over the counter, right? There is no really binding agreement. So the risk in forward is higher than the risk in future. Future is standardized, right? It can be controlled. There's a market that controls it. So that's how we also have it in options. We have exchange traded listed options. Any option contract listed on a public traded exchange. And what are the positive futures, right? It can be bought and sold on a recognized exchange. So the risk is low because why?
Sorry.
There's a
So
record. Okay.
sorry, you are rushing. I actually missed a point in that when you started this exchange traded option. You said there is one that is over the counter, and I really missed that point. Future and forward. Sorry.
Okay. Sorry, I'm sorry that I'm rushing. The reason why I'm rushing is because I know we still have one question to solve, right? One question to solve. So I'm trying to rush the notes. Okay, I will slow down a
Mm.
little bit. Apologies.
Because I really
So, like,
that information, I really need that information.
okay, so what I said was that, you know, we have different types of option, right? We have exchange traded option and we have over the counter options. Can you see these two?
Yes.
We have
Yes.
exchange traded and over the counter. What I'm saying is that
Okay.
this exchange traded option is just like futures, right? And this second one, over the counter options, is just like forward.
Forward. Okay.
And
Okay.
what
Okay.
was I trying to say? I was saying, if you notice that the major difference between a future and a forward contract, right? The normal future and the forward contract, you know, is that future is is an organized system, in the sense that there's a formal exchange where you can trade futures, right? While forward, you don't need a formalized setting, right? You don't need a formalized setting. It can be between me and you. Me and you, we can just come together and sign an agreement. Or I can go to a bank and sign an agreement. If the bank defaults, nobody will owe the bank, right? So it's over the counter. That's what we call na me na you transaction, like informal transaction. Do you get? So it's just between me and you. It's an informal setting. That's an example of a forward contract, right? And I said in this exchange traded listed option is like a future, because why? It is more organized, it's on an exchange. That's why in future contracts you will see things like margin accounts, abi, if I'm not
Yes,
mistaken.
yes,
So
yes.
it's so you'll be servicing your margin calls, like you'll be depositing some money so that when on the day of crystallization, the gainer will gain his money, and you, the loser, you'd have
Sorry,
managed your loss. If
sorry. Which one
Okay,
is
I'm with you.
more like a cost? Which one is more like a customized option? Is it traded or over the counter?
For customize
Like
is
more
over the
like a
counter.
customized over the counter.
Customize is over the counter, yes.
Okay, over. Okay,
Forward
all
contract
right.
are customized now, because you can agree on the bundles, right, in a forward. But futures, you cannot. Is either you are buying maybe 1,000 or 2,000. Do you understand? Those ones are fixed. But in forward, you can customize it to fit into what you want to achieve. Do you understand?
Yes, yes,
That's the idea of customize here. So, like I said, what are the positive features of exchange traded as we have it here? One, it can be bought and sold on a recognized what exchange through a broker, right? And what there's price transparency as we have it in future. There is price
yes,
transparency. So quoted premium should represent what fair value. And lastly, it can be easily resold during their lifetime before what expiry. But what are the drawbacks? One, only available in standardized contract size. Can you see now? You can remember
yes.
standardized and customized. Standardized is
Yeah,
mostly
that's
for futures,
future.
and customized is mostly for forward. So that's why I say
Oh,
this exchange traded option is just like what? It's just like futures, right? When you remember futures, you will remember this guy easily. But because this one is just for options, it's for options, right? So that is why. So it's available on a limited number of what underlying assets, and is limited number of exercise prices and what an expiry date. And lastly, obtained via a broker who will charge a small commission. The reason why I had to teach this is because, my sister, this thing came out live and direct for me too. Most times when I intentionally give you some notes,
yeah.
it's because those things came out for me. And I remember that my colleague that wrote this exam with me, the guy wrote something when we were not talking it when we were not discussing after the exam.
Mm.
The guy said he wrote this question came out. He was writing. He thought he had written, and I said, okay, what did he write in those things? He was not telling me all the things he wrote. I said, Oga, you don't miss Samo. You wrote rubbish. But because me, I knew it, right? And I think those were the things I read before I entered the exam hall. So when this thing came out, it was like bonus mark for me. When you calm down, I calmed down and wrote it well. Like I took my time. And it was, now they won't give you direct like this, it will be applied. So
Yeah,
I can even remember the question. The question was like, okay, you
I've
have a
seen it.
student. Okay, you see that
I've
question,
actually,
right? Uh-huh.
I've seen it. Yeah,
So yeah,
that
so
was why. That
I
was
calmed.
why. That's why I'm asking you because
Okay.
I've seen that question, and that question is not a
Uh-huh.
question where you will see it on textbook. It's just something that will just straight up.
Uh-huh.
It's
Thank
not
you.
something that
I
you
told
will
you.
read like you
Uh-huh.
will see in the
So
textbook.
yeah, that's what I
Exactly.
told you I told you that it came like an applied question. It's an
Yeah,
applied
like
question. But if you understand the fundamentals of this, you will know how to tackle it. So because me, I understood it, right? As a star boy I am now, top three best
uh,
Nigerian students.
so
So
shit.
so I was able to tackle it, and those were the things that gave me what that good mark that I had in my own time. So yes, so now what are the potential, right? Is what I've said, okay, I've talked about the potential. So that's that about that, right? And let's move on. Let's move on to the over the counter. So look at the over the counter, right? The whole TC options are available from banks, what by individuals, what negotiations. So that's what I was telling you. Like it's just informal, right? It can be between banks and an individual or between two individuals, right? So it's over the counter, it's informal. So the positive features are this. Look at now, like what you said, options can be what can be customized. You can see now options can be what can be customized. I told you that is like a future, like a forward contract.
Forward.
So the options
Mm.
can be customized to the purchaser's was specific requirements. The options can be of any size, exercise price, and what expiry date, and may include what exotic futures, e.g., barrier options, Bermuda options, or Asian options. So you can ignore this one. This one is just additions. So what are the potentials? What is not transferable or is what non-negotiable? It cannot be resold, right? Because why? There is no exchange. There's no exchange. There's no standardized exchange system where you can do those trading, right? So you cannot resell it. You cannot resell it. So early cancellation of the contract will incur what? Significant what? Penalties, right? And what? It is more expensive than what? Exchange what? Traded options. Let's move on. Now, what are other terminology we have in the money? When we say in the money, what do we mean by in the money? An option what that possesses intrinsic value, right? A call option is in the money if the current market price of the underlying asset is above what the what exercise price, right? So from a call option perspective, if the current market price of the underlying asset is above what the exercise price. From a put option perspective, if the current market price of the underlying asset is below what the exercise what exercise price. So from a call option perspective, if the current market price of the underlying asset is above what the exercise price, it's a gain for you, right?
Yeah. Okay.
Do you understand? Do you understand when I say is a plus for you? You've done
No,
options
I
now.
don't know.
If the
No.
current market price, let's say you lock a deal now. Me and you will lock a deal now. Like, right? Let's say, oh, I'm going to get this. Let me just use a typical example. I'm going to get this system from you at 15 naira, right? That's the exercise price that we both agreed. And on the exercise date, the current market price of that asset is maybe 100 naira. And me and you, we've locked 60 naira. The
Mm.
beauty is that you are going to sell it to me at 60 naira, right? Call option,
Yes,
right?
yes.
And you are going to sell it to me at 60. But do you know that when I go to the market to resell it, how much will I be selling it?
You said it more.
I will sell it more because at the current market price, it's 100 naira, right? So that's why I said a call option is in the money if the current market price of the underlying asset is above what the exercise price. So it's also the opposite for the put option, right? The opposite is for the put option. Now, what is now out of the money? Out of the money is an option that only what contains what extrinsic what value. And what does this mean? A call option is out of the money if the current market price of the underlying asset is below the exercise price. So at that point, the option holder is losing, because
Yes.
if the market price is lower than exercise price, it means that you are buying it higher than what you can sell it in the market. So that's out of the
Okay.
money. You are not
Money.
is you are not you are not is not is you are not gaining. When we now say at the money is when what the current market price of the underlying asset is the same as the exercise price. So cancel. You are not gaining, you are not losing, you are just at par.
Mm.
I don't know if
Okay.
did Emmanuel take this part for you? Did he explain all these ones?
No, that's why it's actually a new information though.
All
But
right,
I'm
all
getting
right.
it. I'm getting
Well, it's just that you will not appreciate me. So, but let me continue
it.
doing the good I can do. That's just a joke. All
Okay.
right, that's by the way. So the buyer holds a right, the option seller owes an obligation. An obligation, right? Sorry, that hand is supposed to be an obligation, not
Okay.
not an obligation. So
Yeah.
what is V call? So V call is what? V call is area of PA minus PE, right? When we say V call, area of PA is just the purchase the exercise price and the asset price, so or zero. And so that's you can hold on this one, right? We are still going to a place where we are going to see how this play out. Just have this one in your mind, that V call is the higher of the purchase of the underlying asset minus minus the purchase of the exercise price, or zero. And this the V put. So just have it that will give you a clearer idea of what this means. So what is intrinsic value? We've been talking about intrinsic value. An option's basic or fundamental price of value. So intrinsic value is just what? The option basic or what? Or fundamental price of value. It is the profit that a purchaser could make if the options were exercised what? Immediately.
Immediately. Okay.
Yeah. Hold on, please.
Okay.
Let me attend to my oga at the top.
Okay.
All
No
right.
problem.
All right. So let's move on. So we have this here. We have value of an option at maturity of pyro. At maturity, an option market price equals its intrinsic value, which what? For call options, higher of purchase of underlying assets, right, minus the purchase of exercise price, or zero. For puts options, higher of PA. I think it's just repeating what we said in the first. that part. So now we now have at maturity, we have at prior to maturity. Now the value of an option is the present value of the expected payoff, which is what intrinsic value what plus time value. Time value is always zero at option maturity, but before maturity it is not. Time value is always zero at option maturity, but before maturity it is not. We are still going to go back to this, so don't stress your head too much. Now, factors that influence the value of
can you please explain that thing? Sorry. Time value.
is it the prior to maturity part?
Yes, time value is always zero at option maturity, but before maturity is not.
The idea of time value is this. What they're just saying then, the time value is always zero at option maturity. It's just showing that things that but at normally it's just like how will I explain this thing? Futures, right? If we I'm looking for a best way to explain it is so let me see how I can simplify it. When they say time value is always zero at option maturity, but before maturity it is not, right? Normally, so in normally when there's usually an intrinsic value and there's usually a time value. Time value what is some amount, right? Is a particular amount that is earned during a time value in a time space, like before the when you enter into the contract and the exercise price, right? There are some movements in prices that happen between that time. So normally what they are saying is that on that exercise price, it is deemed as if whatever would have happened within the time frame, right, between the time what you guys enter into that contract at the exercise price, it is what there is nothing, is zero. It's just like basis points. On maturity, I think it's future or forward. On maturity, basis point is zero. Because why?
Yes, yes,
You've do you understand? So it's
yes.
something like that. That's around this option maturity and the like, when you're applying that basis point to it. So that's just
Okay,
it. If you understand it from that part, that's the application here. So
okay.
let's move on. So factors that influence the value of an option. We have one, PA, underlying price. That's that PA you have been seeing. PE, exercise price. R, your risk-free rate, right? T, your time to maturity. And S, your annualized standard deviation. Those are the factors that influence the value of an option. So when you have a question and they're asking you the factors that influence the value of an action, in whether an applied form or a direct form, these are the 5 things. One, the underlying price. Two, the exercise price. Three, the risk-free rate. And T, the time to maturity. And next, the analyze standard deviation. And that is what we'll be using for option for option pricing, right? These are the five elements or five variables that you need when you are solving question that is related to option pricing. If you don't have these five, you can never get the option pricing of any question, right? So you need these five: underlying price, exercise price, risk-free rate, time to maturity, and analyze standard deviation. I'm trying to rush so that we can finish this by 8:30. So we have 1 hour to solve the question. Now, how does this work? So option pricing, real options archetypes, right? Normally I told you that real options, we use it in investment appraisal, right? So we want to see how options now flow into investment appraisal, and it can be in three ways. The first way is when there's a delay option. The second way is when there's an abandonment option. The third way is when there's an expansion option. And the fourth way is when there's a redeployment option. There are four, right?
Okay.
When we use it in advanced in investment appraisal, and I'm going to be showing you how we do that when we solve a question. So don't stress your head too much. Just flow, right? Just flow. All right.
Okay.
So one, delay option. When we say delay option, what do we mean? Now, right to a project over a specified period of time, which can be exercised at a later date. When we are talking about delay option is a what? Is a call option. So for instance, now we can do an appraisal, right? We can do an investment. Normally the idea of investment appraisal is that we want to build a project, right? We want to build a
Yes.
project and see whether there's going to be a cash flow that would offset the cost. That's the essence of all those net present value we're doing up and down. So the
Yes.
idea of delay option is that I want to see that, okay, if I do this project, right? If I sell it, at what price can I sell it at a later date? Right? That's a delay option. ability to delay the project and maybe sell it in the future. That's what we call delay option. And it's usually what it is called a call option. So it is a call option approach that we use in solving any questions that is relating what to delay option. So it's your duty as a student when they give you a question to know whether, because they will give you an information, they will not tell you it's a delay option. It's your ability to decode it, whether it's a delay option, whether it's an abandonment option, whether it's a what, whether it's an expansion option, or whether it's a what, a redeployment option that you want to solve. So please note that is on you to decode. They won't tell you that it's a delay option or anything. It's you that will know, this is a delayed option. And if it's a delayed option, the approach you will use is different from others. So and others too. Is the approaches are what are different. So now I told you that before we said there are some 5 elements you need. Now for delay option, these are the 5 elements you need. Right? Let me start from down. The risk-free rate is the same for everything. Whether you are doing abandonment option, whether you are doing delay option.
Yes.
All right. See, can you hear me? I know you lost me for a while.
Everyone sent you a message, so
All right. I know you lost me. I got it from here, so
okay.
I had to reset my network. Let's just bear with us. Sometimes we enjoy it, sometimes we don't
No,
enjoy the
it's fine.
network.
No, it's fine.
All right. All right. So I told you now, let me start from down, which is I'm still on delay option. We have the risk-free rate. If they give you a question, right? If they give you a risk-free rate, whether it's an abandonment option, whether it's an expansion option, whether it's a delay option, the risk-free rate is the same. If they give you the annualized standard deviation, which is S, the volatility of the project cash flow, that's an annualized standard deviation. So they will give you in a question is the same. Time to expiration of the option, the time might is usually the same, like it's almost the same variant, right? So those
Yeah,
three
I have
TSR.
question. I have question about
All
that
right, what's your
time.
question?
That
All
time
right.
for delay,
Mm,
is it before delaying or after delaying? Then that time for selling,
is
is it before
mm,
selling or after selling? Those time.
the time the time to expiration of the delay is before the selling.
Okay. Now
Is
what
before the
about
selling.
delay?
Is before.
So all the
No
time is
delay. No
before
delay on. No delay on is before the time. Almost everything self is before.
before.
Everything is
Okay. I
before.
just want to be sure.
Yes,
Okay.
it's before. Yeah, everything is
Okay.
before. Yes.
Uh,
So we now have these two. We have PA and PE. When we talk about PA is the present value of project cash flow discounted what at project or company work. Don't forget to when you are solving for PA, present value of project free cash flows discounted at what project or company work. When we talk
so
about project
so
work,
for
we're
that
talking
PA
about
now,
project specific work. Yeah.
so PA now, PA, is it after those delay options and abandonment options or before those delay options?
So for the delay,
For
for the
PA,
delay,
no, both delay and say okay.
I understand what you're saying. If you look at sell, look at sell. I think where is that one? No, for is abandonment. Is abandonment okay? So if you look at abandonment, look at the present value of cash flow expected after expiration date. Those are foregone cash flows, meaning that those are what? Those are the cash flows after. That's for
Okay.
withdrawal. Do you understand?
Okay.
For abandonment tone. After
Okay.
foregone cash
Okay.
flow. When you sell it, the cash flow that you'd have gotten normally if you had not sold it after you sell. Those are what
Yes.
foregone cash flows. So that's for abandonment. But for
Okay.
delay is all the cash flow up to the point of delay. Yeah. All right.
Oh,
So let's
okay.
move on.
Okay.
So
Okay.
YPE is what initial investment based on prices in existence at the what expected expiry date. Don't take present value. I intentionally include this one. So don't go and think in PE, you take present value. You don't take
Okay.
PE. It's only PA that you take present value. But
Very
PE is the
nice.
initial investment. Yeah. So
Investment.
that's delay. So abandonment. What's abandonment? Abandonment is also called a withdrawal or exit option. This is the option to sell the project to a third party for a pre-agreed price. So I can build a project now and sell it, right? When I sell it, that's an abundant option, and it has the characteristics of a put because you are selling. Put is to sell. Why delay is what? Delay is call. I want to do this project, right? So I may not do it now, I may do it later. That's the ability to delay. Is a call option. While for sell is a what? While for abandonment is a sell because you want to sell what? The asset. So one, the PA, which I've said, present value of cash flow expected after option expiry date, foregone cash flows. And PE, the realizable value of the project if the abandonment option is what? Is exercised. So don't discount, please. The realizable value so for most of it, is their PA and their PE that are different, but there are other factors which are times, deviation, and risk free
Yeah.
rate. They are usually the same. Sure, you understand? So take note of P and P. You must know those P and P for each of them. That's what you should pay attention to more. All right, so move on.
Okay.
So we have the third one, expansion. Under expansion option is a what? It's called a growth or learning option. So this is the ability to expand production or what, or service in the what, in the future, right? Hence the initial project provides the company with the option to call future projects in the future. So expansion is that, oh, I've done this project, I want to expand, right? So you see it in the question, maybe the question is tilting towards, oh, they want to expand or blah blah blah. You already know that is a expansion option that you should use here, right? So, and one, what makes it different? The PA and the PE. If you notice, I didn't put T, S, and R here anymore. Because why? These are the only factors that changes for everything, right? So for the PA here, present value of what? Additional cash flow generated by the what? By the expansion. So it's the present value of the additional cash flow, right? Not the current cash flow from your current project. It's the additional cash flow generated by the expansion. And the P is what? Is the additional investment required, not in present value, please. Whether it's in third year, whether it's in fourth year, don't take present value, right? Use it as absolute. If they give you 30 million, whether they said it's going to happen in the third year, don't go and discount it. Use it like that. Is that 30 million that you should use? Because why? You don't take what? The present value, right? And don't use what? The initial investment that was done on the current project. Is the additional investment required for the what? Expansion project. Please. Thank you. Redeployment option. This one you don't usually use it in practice, but just know it for knowing sake. It's also called a flexibility option, where the project asset can be switched into an alternative. Hence, the asset in the project can be called to perform alternative function. Like I said, is not usually is rarely used. So I don't think at even most times at ACCA level, it's only those first three that they test you on. They don't usually test you on the redeployment option. I just included it for you to what, to have a knowledge about it. So let's move on to that. Now we now move to, we're almost done. We just have 2 more slides. Okay, so by 8:40 we should be done with this so that we can move on to question ASAP. So normally for this level, you are usually giving what, the Blasco option pricing model, right? To use. And before this time, right? Those that things have been better for us. Before this Blasco's option pricing model, it has a formula that before you would have calculated manually, right? BSOP model,
Okay.
you would have calculated what, manually, to get all those option amounts that you want to get. But now, when they looked at it, they said it's not usually necessary anymore at ACCA level. So what have they done? They've made it easy for us. They've given us a BSOP calculator, right? If you have been solving some questions, you see some questions that has BSOP calculation. So if in your exam and in your question sheet, in your question, right? You know, normally they will give you Word documents, they will give you Excel. If they include BSOP calculator for you, just know that there's a question involving option. But if you are lucky and there's no BSOP calculator, that means they don't require you, there's no any BSOP related question in those three questions they will be setting. But if you see BSOP calculator, my sister, option question is waiting for you. You cannot run away from it, right? So, and normally, like I said, this BSOP, what, this is an option pricing model that use specific variables to calculate what the theoretical value of an option as an estimate of what an option should be worth, right? Using all inputs. And all those variables are what I gave you. Those five: the PA, the PE, the T, the S, and the what, and the R, right? And what are the assumptions of the BSOP model? So I've seen questions, plenty in past questions, where they might not give you question, they might not give you calculation question on BSOP, but they will ask you this assumption, right? So what are the assumptions? Just know it, whether you cram it, whether you know it, whichever way. If the question that has maybe written part has to do with what, tell us the assumption of BSOP, is a bonus mark for you. One, no dividend is payable on the share during the lifetime of the option. So those are the assumptions that was factored into what, into the formula that was made for BSOP. These are the assumptions that were made. No dividend is payable on the shares during the life of the option. Two, the option is a what, is
It's
an
European
European what, call
call.
option. So it's not American style, it's European, right? Three, returns from the underlying asset follow what, the normal distribution. Four, a risk-free asset what, exists. And five, perfect market, right? I know I've explained perfect market to you. Free available information, rational investors, and what, no transaction cost. What are now the limitation? Theoretically, the forecast volatility of returns should be input, but in practice, the historical standard deviation of returns may have to be what, to be used, right? And two, a true risk-free asset does not exist in what, in any economy. Even treasury bills carry some small likelihood of default. Yes, you might say government security is safe, but it's possible that government what, can default on his what, on his investments. Give me an example of a government that defaulted on their bond in 2022 or 2023. I want to see whether you have asked.
Hmm. That would be.
There's an Okay, that will be what?
I don't know. Sorry.
Try. Okay, let me limit it. African country.
The government limit what?
I said I'm limiting my
No,
this thing
no.
for you.
You
I
said
said
you said the government
the
defaulted on their bond.
defaulted on their instrument. So they issued an instrument. Normally we normally say that government instrument is risk free, meaning that if I invest in government bond, the likelihood that
Mm,
they will default is very low, right? I will
mm,
get my money and my interest back. But I'm
mm.
telling you that there was a government that defaulted on their instruments, their bond instruments between 2022 and 2023. Which country is that? Is an
In
African
Nigeria
country.
now.
Nigeria call. Why is your mind going to Nigeria? Nigeria has never defaulted. We are always
Okay,
performing on our
that,
instruments.
that
The
should be
government
Ghana.
have the, thank you very much. It's Ghana. They are Euro bond.
Okay.
They are Euro bond. They issued the Euro bond, right? And they could not pay. Almost all companies that invested in that Euro bond, they suffered a loss. Because why? They had to
Okay.
take a haircut. They lost principal, they lost interest, right?
Interest.
So many companies invested in it because why? Ghana Euro bond was having one of the highest returns, right? In terms of coupon, interest payments, interest accruals. But what happened? They defaulted, and when they defaulted, so many banks, so many individuals, they suffered a big blow because why? They had to forfeit part of their principal and their what, and their returns. So that's that. So that's why I just added that to buttress this second point, that a true risk-free asset does not exist in what, in any economy. Even treasury bills that we buy carry some small likelihood of what, of default. And lastly, this is the formula for BSOP, right? You might want to know it for your personal use, but I'm telling you that in the exam you don't need it. Normally before our time, right? In those days, all these things you will calculate it. You can see that this C is call, right? Price of call options. Normally we'll calculate it. We have to get what, all these variable ND1, ND2, PA, and all those blah blah blah. We are going to calculate it, and we're not going to put them in this formula, right, to calculate. But now things are now better. You don't need to rack your head on this one. Don't stress yourself reading this, because why? A BSOP calculator will be provided in the exam. What you just need to identify for that BSOP calculator is one, PA, which is the price of the underlying asset, P, which is the exercise price, which will be given in the question, R, the risk-free interest rate, T, the time to maturity, S, the annualized what standard deviation. So those are the things you just need to get. Those 5 variables, plug it in the BSOP calculator, and you will get your answer. Let me give you an example of a BSOP calculator. I was trying to get it from your portal, but I could not access it because I'm no longer a student. So I just want to show you how a BSOP calculator works. Mostly they use it for stock. Can you see my screen?
Yes, I can.
So you can see normally you have something like this in your own platform, BSOP calculator, which usually have what? Normally they use it for stock options, normally BSOP, right? That's what is usually used. But normally we now apply it under what? Under investment appraiser, right? We apply it under advanced investment appraiser, right? We bring it into it. But normally for options, it's usually used for stocks, right? To value stock options. So yeah, this current stock price you are using, normally I would have included in your own BSOP. They will give you like is PA, right? You put PA here. Strike price is your PE. Time to maturity is your years. This dividend yield, ignore because we don't need dividend yield, right? In advanced investment appraiser. Volatility is that what? That standard deviation. They will give you in a question. And the risk-free rate is what? Is the government risk-free rate that they will give you. By the time you plug all these things, you now come here. They will give you the call option price. They will give you the put option price. You will see the result also in your own BSOP calculator on your portal. They will give you a call option price, a put option price. This is where some people usually make mistake. Now, my question for you is that when we've plugged in all those variables, are you following me, please?
I'm following you.
All right. When we plug in those 5 variables and call option price comes in and put option price comes in, if it's a delay option that we are working on, which one are we supposed to pick? Is it the call option or the put option price?
That's the call.
Thank you very much. Call. If it's the abandonment tone or withdrawal, what are we supposed to pick?
Both.
If it's not the expansion tone, what are we supposed to pick?
That's call.
Thank you. So that's fine. So let's move on. So, all right. So that's that about that. So we now move on to a what? To solve a what? To solve a question. So travel with me to the question I dropped on your WhatsApp, right? I want to open it for my system. I
Okay.
dropped Chomra. Have you seen it? Have you opened it?
Yes.
All right. So um can I just give you 5 minutes to just read? Right? Is that fine by you, or we should just do it together once and for all?
Let's just do it together.
All right. You don't even want to give me break at all to go and pick my cook. You are very wicked.
Oh, yeah, come on, pick up. It's because you
Ah,
said it's because you are saying is the time.
you
That's
cannot
what
say
I'm.
you cannot say, oh God, just go and just rest more. I know you are using style to rest more. That's why you are giving me 5 minutes. Ah,
Rhea, please go and pick it up.
all right, I'm joking. Okay, just give me 2 minutes.
Okay, it's fine. It's fine.
Let me get something to drink. So this is it on the screen. Just quickly go through it, and within 2 minutes we'll start now. Let me just stretch and get my
Okay.
let
All
me
right.
get something to drink. So let's start. So have you gone through the question? Have you?
Yes, I am.
All right. So is this something you've come across, or we should just
No.
skip so that we'll know? You know that these days me I don't trust you because the way you be reading, so that's why I have to always ask you. I won't have to waste my time. Is this something you've come across, or?
I don't know. It's quite complicated. Okay.
All right. So let's do this. You're a scholar, so scholars they usually read very well. So you have to be careful when you're dealing with them because they are sophisticated clients.
God, I beg.
Sophisticated clients. If you are not intelligent, they will sweep you off your feet.
Hmm.
They will just throw you one question in between. They will scatter your head. all your ego and morale would just go down.
I, have
All
you
right, let's.
experienced those people before?
Why not? I've experienced one or two now, but like I said, you can never catch me now. I always have
Okay.
answer to your question.
All
I
right,
always
cool.
have answer to. I always have answer to your question because it's something I understand both on theoretical and practical view. Sure, you get. So these are things I do normally. So no
It's
matter how you want to throw those.
because that is
What did you
why.
say?
I mean,
So
it's on the job.
yeah, so it's on the job. So I do it on the job also. So you might not be able to get me
Mm.
because I have the understanding theoretical and practical. Most tutors, mostly is usually theoretical. It's not what they do in practice. But the benefit for some of us is that because we do that on theory and also we do that on practical. So when we are looking at it, we understand the practical view of it. So it's easier for us to tell you how it's been done than just giving you theoretical crammed knowledge of it. Right. All right. So let's move on. So let's just go to the requirement. You can see this is a question. This is a sweet 15 marks question, right? This is a sweet 15 marks question. So, and if you notice, these days it's 15 marks questions I'm going to be dealing with. I don't have time for short ones. When I bombard you with 15 marks questions, there's I'm so sure by the time you are entering the exam, you are going with that boldness that there's nothing they want to set. Because why? You've solved very thick questions that cover most of the things that they would give you. All right, so now discuss the role of the World Trade Organization and the what and the possible benefits and drawbacks to mayhem of reducing what protectionist what measures, right? So that's why I told you that you should go and read on all these parts, all those protectionist measures and all those things. So protectionist is just what we're just trying to do on protectionist measures is just to what protect what our local industry, right? So protect our local industry in the sense that normally the goal of every country or maybe economy is to what is to grow their own economy to internally. So the idea of depending on external supplies is only killing what your economy. So for instance now, if for instance why is China better than most economies now? China has looked at it inward and now they can produce what goods and services at a very cheap at a very cheap amount that most countries are depending on them. And that is what is growing China's economy and their reserves because of these production skills that they have. Also in Nigeria, we are highly dependent on we're highly dependent on imported goods and services, and that is one of the things that is killing us, right? But when the day we decide to look inward and we decide to start producing ourselves internally and also selling out, it will increase our value and our economy. And thank God for Dangote refinery. Before we are highly dependent on importing um, um, fuel, right? But now we are also producing ourselves, and you will see now that the Americans they are buying from us also for their aviation fuel. They usually get from us. Look at how it has improved and our economy by stabilizing the foreign exchange in the economy, and also we now have more foreign exchange because when they buy, they pay us in dollars. It helps us improve our base in the sense that we're not we won't have to be sourcing for dollar. Now we can see that for a few months now the dollar has been stabilized to some extent. We've not exceeded 1.4. It has been between 1.4 something, 1.4 something. That is the benefit of a stabilized economy. And Dangote played a very big role in that aspect because normally before we normally import crude oil and fuel, right? Processed fuel, right? And we use dollar to pay for that. But now we don't do that anymore because why? The Dangote fuel is serving the whole nation. And if you notice recently, Tinubu signed the bill increasing the import duties for fuel, meaning that any individual that wants to import fuel to sell in Nigeria now, there's a 20% extra charge that you pay from the normal import fuel duty that you are paying. There's a 20% increase now that you pay. What is this? What they are just trying to do is to discourage people from importing fuel into the country because why? It is killing the economy. What people wants to do is to encourage the one that we're producing within, which is that Dangote own, and every other private institution that will stand up to be like Dangote, so that why we won't have to be depending on sourcing for dollar to import fuel. Those are examples of protectionist measures, right? So I've just given you an example of protectionist measures, right? It's now your duty go and read on World Trade Organization and see how their rules are, and the benefit and the drawbacks. So you can read on all those ones yourself. Move on. Now, B, they told us prepare an evaluative report for the board of directors of Muraco, which addresses the following part and recommends an appropriate course of action. One, an estimate of the value of the project before considering Bulut's co-offer. Show all relevant calculations for T-Max. An estimate of the value of the project taking into account of Bulut's co-offer. Now, they now said in 3, a discussion of the assumption made in 1 and 2 above, and the additional business risks which Chumraco should consider before it makes the final decision. So those are the requirements. Very sweet question, and enjoy the ride as we move on. We'll solve only this and we'll call it a day. All right. So let me have it like this. So one, they said since becoming independent just over 20 years ago, right? The country of Myanmar has adopted protectionist measures which have made it difficult for multinational companies to trade there. Can you see? So you are discouraging multinational companies to trade within your economy because why you want to encourage your own local industry. However, recently, after discussion with the World Trade Organization, it seems like that Myanmar will reduce its protectionist measures significantly, right? So what trade normally do is to balance it, right? Don't do too much, right? We are we are co-independent, meaning that we are interdependent. That's the right word I'm trying to use. Interdependent on each other. Whether you want to grow your economy, you still need US, you still need China, because why? We are interdependent on each other. So those are the functions of World Trade Organization. Now, encouraged by this discussion, Chumraco, a company producing packaged food, is considering a project to set up a manufacturing base in Meham. So Chumraco is a company not necessarily based in Megam, but because why Megan has now reduced their protectionist measures, they are considering investing in Meham. It's just like an example of those foreign operations that we did last week. So they want to invest in Meham. They want to build a manufacturing plant in Meham to sell its goods there and in other regional countries nearby. So they will produce. Want to have it's just like China having a manufacturing base in Nigeria and selling their products in Nigeria and also selling it in other regions like Ghana or Sierra Leone around Nigeria. So that's the meaning. An initial investigation consisting of 500,000 established that Megam had appropriate manufacturing facilities. This investigation cost, do we need it in the advanced investment appraisal variables?
No,
Why?
it's a past cost.
Thank you. Not past cost. What's the right English? What's the right word?
Like sunk cost.
Thank you. No embarrass me. Which one is past cost? Sunk cost. All right. So there's adequate transport links and it was reasonable skilled but cheap workforce, right? The investigation concluded that if the protectionist measure were reduced, then the demand potential for Chumraco products looked promising, right? It's also fair that an early entry into Meham would give Chumraco an advantage over its competitors for a period of 5 years. So meaning that if Chumraco enter Meham, it will gain a competitive advantage for a period of 5 years, after which the current project will cease due to the development of new advanced manufacturing process. Meaning that this project is a period of is for a period of 5 years.
Hello?
Can you hear me now?
Yes, I can hear you.
All right, all right. Let's move on. I know where I stopped, so don't worry. So they said, so so I talked about look promising, right? And I said because they've told us now that it is also felt that an early entry into MEAM would give what Chumrako what an advantage over its competitors for a period of what of 5 years, meaning that this project is for a what for a 5 year what period, as they've told us. After which the current project will cease due to the development of new advanced manufacturing what processes. Thank you. The peso is currently at trading at what 72 mega MP per what per $1. So now the manufacturing plant will be what will be in Megam, right? So meaning that
Yeah.
is Megam currency we're using. So let's start putting on our stuff so that we'll not we'll not waste time. So one, and now normally I've told you that mostly your calculations is usually what on the Excel and is what appendix, usually an appendix. So you put it there because when you are writing on your word, you will refer to the appendix. In appendix one, the value was blah blah blah. If it's favorable, fine. If it's not favorable, whichever way, reject or accept. So let's move on. So it's an appendix, right? So and what have they told us to do in that question? They told us to what? I'm trying to create the table once and for all, an estimate of the value of the project. So let me just be putting that one now. Estimation appendix, estimation of the value of what of Megam what is Megam project. So I think they said the first one, estimation of the value of the project before considering Bulu's offer. So let's just start putting everything like this. Before Bulu'd offer. So we've created one. And like I said, normally, we normally put cash flow in what? Is it in millions? Let's just do in millions so that we won't make it too big. And it's in MP because they told us that in that country, this thing is what? He told us that is MP. Megam's currency is the peso, which is MP. So in peso, so in millions, which is what? What? NP. So I've created sharp. You can be doing that into on the exam day. You can split, you can split your screen like this on the exam day. This is what I normally do. Hope you know.
Really?
Because in my own time, what I normally do is normally we have like 4 appendices in number one. I will create the 4, I will open the 4 like this side by side with my Excel. So I don't have to be going back. I'll just be going straight to where I want to move on. So everything will be on my screen like this. The four sheets that they've given me for the question, and also my Excel and Word. Everything will be on my face like this, and I'll just be pasting and be playing around everything. That's how I was working during my own time. That one too saves time. Instead of going close one, open two, close two. No. So we have
But
here.
it's actually 4 exhibits. I'm not sure you can be
mm,
able to open 4 at a time, maybe 2 at a time.
you can open the file at a time and arrange it. I can give you an example. Maybe of this call when you share your screen with me, I will tell you how to do it.
Okay.
Me, I will open
Because
my 4
you
at the same
normally
time. That's
what I do is I put two, like the Excel one side and what
mm,
I'm doing one
mm.
side instead of four, because when you put four, it's cluster everywhere.
Eh, ah, well, what difference. Me,
Okay.
I can work with whether clustering or whether non-clustered. All right. All right. Let's let's move on,
Oh,
Dari, before you use English to kill me. Cluster. Sorry, you, Madam Cluster. All right. Yeah. So I already said it's a 5 year project now. So we have year zero, year two, year this year two, year three, year four, and what? Let me move this one here so that we will see the full screen. I'm just
what you
creating all this one on time so that.
did
What
is
did you
very
say?
funny. I say seriously, what you just
Eh?
did is very, very funny.
What did I do?
I said what you just said is very, very funny.
Shade
It's
Madam Cluster.
It's a
Let's move on there.
yeah.
All right. So, are you with me?
Yes, I'm with you.
All right. So we've created it like this now, right? So now they now told us that. Where did I stop? Oh, all right. So Megam's currency, the peso. I'm already on this next paragraph now. Megan's currency, the peso, is currently trading at 72 mega peso per $1. Setting up the manufacturing base in Megam will require an investment of what? Of 2.5 million immediately, right? Note, initial investment of 2.5 million. So we need 2.5, right? Then that told us that to cover the cost of land and building, which is what? MP have won 250. So me, because I use Excel and I'm not writing, so I can start plugging straight. So land, right? What do I need? I need what? You will be talking to so that I'll know that you're following me. Land is what?
I know both of them is 2.5.
What is land? Land is what?
And is 1,250.
Yes.
Machinery is 1,250.
So as a professional, split it, right? It makes your
Okay.
work more neat. So 1,250, right? And you know this one will be negative now because it's an outflow. So
Yeah.
this one is machinery is what? Machinery is what? 1,250 minus 1,250, right? So that's that about that. So sharp, sharp. Don't waste time with plugging. Don't go and be reading question first before you start plugging. And this is how you should. The way I'm doing it, that's the way you should be doing it in the exam. Or please, immediately as you are seeing those information, be open your Excel by the side and start plugging. That's how to save time. So machinery 1,250. They now told us what tax allowable depreciation is available on the machinery at an annual rate on what? On cost on a what? On a straight line
Straight
basis,
line.
right? On a straight
Yes.
line basis. But they now said something. They said a balancing adjustment will be required at the end of what? Of year 5, right? When it is expected that the machinery will be what? Will be sold for 500 million. So meaning that as year 5, they will be selling that project. Because why? Because the project is actually for 5 years. Abi, if you remember, the project is for 5 years, right? Based on the question, they told us the project
Yeah.
is for 5 years. So meaning that year 5, they'll be selling what? The machinery, right? If they are selling the machinery, normally the straight line, the depreciation is 10%. I know normally if you have a 10% straight line depreciation, by default, if you are doing it flat, 10% means 10 years, if you know.
Yeah.
You understand? So now, but 5 years, it's not we are going to depreciate up to 5 years and apply what balancing adjustments, whether it's a balancing allowance or a balancing charge, we don't know yet, but we'll do it now. So if I were you, I'll just quickly go to what to my workings. I can open workings immediately. Let's quickly start solving that one ASAP. So costs, what's the cost of the cost of the machinery is 1,250 abi. So I can have
Okay.
this one here, right? 1,250, right? What's the tax allowable depreciation? They told us is what? 10%, isn't it? So I come here 10%, right? And I do what? I do this minus 10% times what? Times
One
this, right? It will give me this. What am I going to have? I'm going to have the year one.
depreciation. Third.
I'm going to have year one's what? Year one's depreciation. What's this one? I'm going to have year one's. I'm going to have year one's depreciation, which is the difference, right? Right. So this is what that's for year one. So I move again. I apply that, but without wasting time because I'm an Excel expert. I can just copy this side like this and what and paste it here in the next paragraph. It will calculate for the next one. But don't forget to know this one is wrong because why? You are applying what is a straight line on. Let's say you are using reducing balance. You can see that it will multiply the next reducing balance. But because it's what? Because it's straight line, what do? You log this cell. You log this cell, 10% on C43. We'll log this cell because it's what? Straight line. So, and will be what? Will be copying like this. Is it clear?
Yes.
Mhm. So we also do that too. That this second year, we'll do that for the third year, right? We'll do that for the fourth year. We'll do that for the fourth year. Here we have what? Here we have the fourth year. But they said it's fifth year, right? So I think we'll do that again for the we'll do that again. So as we have it, we'll do that again. This one, this first year, this second year, this third year, this is fourth year. So there will also be a depreciation on the fifth year too, because it's for 5 years before they sell it. So you come here, this is the fifth year, right? So if this is the fifth year, but they don't say that year five, at this year five, right? They are what? They are going to sell it for what? For 500. So normally, as we have it before, we'll say sales produce because that's the balance adjustment. Because they're selling it for 500, right? But what's not the difference? The difference between the what? Between the sales proceed and and the um, the tax written down value will be what? Whether it's a balancing charge or balancing what? Balancing allowance. But yeah, because why? The tax written down value is higher than the what? Than the scrap value, right? What are we going to have? I'm asking you.
In
Is it an
allowance,
allowance or a charge? Is it an
allow
allowance or charge? Thank you
allowance.
very much. So we have what? We have a balancing what? We have a balancing allowance. So it will be the difference between this minus this, which is this guy. So sharp, sharp. We've done that already without what? Without wasting what? Without wasting time. We can even come here and quickly what? And quickly plug it as sharp guys, right? Without what? Just come here, start plugging directly, right? Because why? We've done that. Normally what? We normally apply tax allowable depreciation. So when we have to come back and do this, immediately we'll start plugging in straight. This one is for what? This one is for year two. This one is for year three. This one is for year four. 1, 2, 3, 4. 1, 2, 3, 4. This one is for what? This one is for year five. So, and don't forget too, there's also a what? A balancing allowance. You might add it with your year five as salary position, but so that you know what you are doing. Like you're good, you want to break everything down for them. So you can come here, balancing allowance also, right? You come here. So that's that about that. So let's move on. So what's the next thing? So we've killed that one already. So now I said a balancing adjustment will be required. Don't forget that there's this thing. Let me quickly put that one before I forget. The sale of machinery, right? Sale of
Mm.
machinery, the scrap. You
Screen
bring it
value.
here. It's normally, so you bring it here. You can decide to add it on this line 18, but just to break everything clean and blah blah blah, you can you can add this one here. So that one is settled, right? They now told us that the market value of the land and building, right? I'm on the next listing. They said They now said a balance adjustment will be required at the end of the year. Now say when it's expected that the machinery will be sold for 500. We've done that one after inflation, right? So they factored in inflation, right? Please, they factored in inflation here. So let's say the question has to do with inflation, right? They've already factored in inflation. So don't go and apply inflation again because they've told you here that what is after what? After inflation in that bracket. So now to the next, they now say the market value of the land and building in 5 years' time is estimated to be 80% of the what? Of the current value, right? Of the current value, this amount are what? are inclusive of any tax implication impact. What are they trying to tell you here? Why they are giving you this market value is that at the end of year 5, when they are selling the project, they will also sell the what? They will sell the what? Land and what? Land and building also. So what do? We come here, sale of what? Of land and what? Land and building. Because they've told us what? At the end of year 5, they will sell the whole investment. They've told us in the first paragraph already before, right? Where's that place that they told us? I'm trying to do for it. Where they say
I
5 years. Hold on. After which the current project will cease. Do you see? We cease. So meaning that they will sell everything, whether land, whether anything, they are selling everything. So meaning that the market value of the what of the land and building in 5 years is 80% of the current value, right? So meaning that I'm expecting what 80% of what of this 1 to 50. So you can see the reason why you should not include them together. Do you see? So let's say you were working under pressure now. You can just put the whole investment 2.5, and by the time you are doing 80%, you go and do 80% on 2.5. Maybe because you're under pressure. You understand? So that's why I said when you have things like this, it's good to break it down so that you won't make mistakes. Yeah. All right. So let us move on. You can see how we are tackling it small like that. So they now told us that Chumraco will require what? 2 million what for working capital what immediately, and it is not expected that any further injection of working capital will be required for the what for the 5 years, right? Will be required for the 5 years. When the project ceases at the end of 5th year, the working capital will be what released back to Jumra. So thank God they did not stress us on working capital. Normally we would have had it where they would tell us that working capital it will be increasing by maybe percentage in changes in sales, blah blah blah. But yeah, they told us all that the working capitals that you'll be needing immediately, meaning that if you need working capital immediately, that means you will need it in year 0. Yes or no?
yes.
Because they said it will be what? It will be required immediately. So they've told us $200 million, right? And they said at the end it will be released back. So meaning at year 5, we'll get back what? The 200. That one is settled. And once the sweet thing about accounting courses is that you wanted to say something?
With this, can you criticize this that you only have one working capital that will just be recoup? At least there should be in between working capitals to maintain the operation of the business. Can this be
Yes,
queried?
now
Like,
because 100%. Your assumptions now is part of professional skepticism, querying the assumption. Do you understand? There's a part in the question, in the requirement, that it will require you to talk to the assumptions, right? I think a discussion of the assumptions. Look at part 3. So you will discuss it here. Like it was assumed that the working capital was fixed, right? Which is not this thing in reality. It's not obtainable in reality because why? As the project is growing, the working capital requirement is meant to increase. Do you understand? So that's part
yes.
of your discussion in the assumption. So which is very good. Thank you for bringing that out. So we've just solved part of number 3. So if I were you, as you remember that one, in fact, in your Word document, you can quickly put the number 3 subheading, right? And talk about, when they are talking about discussion, quickly note your working capital. The working capital was fixed, blah 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 blah. You've gotten your point. So I've told you, in this exam, it's only the smart people that pass. It's not brilliant. You have to be smart. Like you brought that one, just immediately go and plug it. That's the beauty about electronic exam, in the sense that you can write a point and create more lines for what, so you don't have to write in, normally if it's Word, it will be hard for you to do all this thing because you have to create plenty lines and go and be writing down. But yeah, as you are doing it, you just be shifting space, and before you know it, by the end like this, you have a full-fledged answer, right, from all these small add up. All right, let's move on. Yeah. So this sale of machinery, we've done that, we've tackled that. We've talked about working capital, we've tackled that. They didn't stress us on working capital, so fine. So they now told us that production of the packaged food will take place in batches of what? Of product mixes, right? These batches will then be sold to supermarket chains, wholesalers, and distributors in what? In Megam, and it's what? It's neighboring what? Countries, who will repackage them to their individual requirement. All sales will be in what? In peso, right? The estimated average number of batches produced and sold each year is given. So the batches are produced and sold is what they've given us straightforward. They didn't stress us. So let's quickly address that. So it will be part of our workings. So the batches now, batches produced and sold. Let's have it in our workings. Batches produced and sold. So yeah, where's my year one? Where did my year one start from? Year one start from D. So let me just put D here so that we'll be able to monitor. So this for 5 years. And this year 0. All right, so we have this here. So let's start plugging and what and playing with information as given in the what as given in the question. So they told us that these are the batches produced and sold, right? They now told us what that the current selling price, right? The current selling price for each batch is estimated to be what? To be 115 peso, meaning that 115 peso, right? The current selling price for each. So the current selling price is what? Is 115. So meaning that let's first plug the batches produced and sold. We have 10,000. We have 15,000. We have 30,000. We have 26,000. And we have what? We have what? 15,000, right? So we have this and this. So now let's now move to the selling price now. They've told us about the selling price, 115, right? We can put it here. Selling price. Selling price. Selling price is 115. Is 115. That's the current. You can see current. That's now. We don't know whether it's going to be like that in the future, but let's just have it as current here. They now said the costs related to producing and selling each part are currently estimated. So this is the cost. Let me put costs here. Cost is what? Cost in current is what? 46 what? 500. Let's leave that. Now to us that in addition to this cost, a number of produce we need a special packaging material, right? A special packaging material, which is what? $200 what? Per batch. See this, so can you see that currency has changed here?
Because of inflation.
Inflation, okay. I say currency has changed. You say inflation. Look at the current selling price. Look at MP 115, right?
Yes.
Is in peso. Look at the cost. Is in peso 46. Now look at the special packaging. Is in what?
Dollars.
Thank you. So you can see now. So your eyes has to shine well because these guys, they can be wicked. So let me just put dollar sign here. This dollar sign. So let's just be breaking it down like that, so that we'll know what will not make errors. They now told us, they now said training and development costs related to the production of the batches are estimated to be 80% of the production and selling costs, excluding the cost of the special package in the first year, before falling to 20% of this cost, excluding cost of the special package in the second year, and then new for the remaining years. So they said training and development. So mean that if I get the production cost, I'll be able to do what? I'll be able to do training and development, right? Because why? Because it's 80% of whatever I have in my cost of what? In my cost of selling, cost related to the production and what? And selling, cost and selling of each batch. Let me put this one like this. So that training and development training and development. So we have what? We have 80% and we have 20% in the second year, according to what they told us. All right. So let's move on first. Explain so and the need for remaining. Now said it is expected that the cost relating to the production and sale of each batch will increase annually by 10%. But the selling price and the special packaging cost will only increase what? By what? By what? By five what? By 5% every year. So meaning that this selling price, right, will increase by 5% every year. Abi,
Yes.
for selling. Why for cost is what? 10%. Abi.
Yes.
So I can come here. Since this guy, let's say there was a line here. Maybe let me just quickly create it.
A question.
So this
Is
guy,
can,
this guy will this. What did you say?
can I ask a
This
question,
guy
please?
will increase by 10. Oh, you asked me the question.
Um, if selling is increasing by 5 and cost is increasing by 10, is it normal?
Hmm. It's normal now.
So
It's
it's
normal
not
now.
something you can question.
You can question it. There's nothing that you cannot question. There's nothing you cannot question. I'm just telling you based on reality. It is normal, right? It can happen in reality. But can you question it on an exam basis? 100% you can question it. Do you understand?
Okay.
As long as you have a proper justification, you can question it.
All right.
All right, so let's move on. So I will come here. Normally, don't forget that this thing is supposed to be in millions. So everything we're doing here is absolute for now. So we're going to convert them in this thing so that they would line properly. So what can I do? What I can do is one, I can decide to grow the this thing, right? The current times what? Times one plus what? Plus this, right?
Yeah.
Raised to what? Raised to this, raised to power one. Are we following? Is it clear?
Yes. Yes.
Thank you. Uh-huh. So I cannot do this. When I do this, I can lock C because that's a constant. I can lock, what can I lock again? I can lock D. Yes, I can lock D. Yes. I can lock D, right? And I will grow everything to get this selling price. So these are the selling prices across. Meaning that automatically I can calculate my sales revenue, right? I can say my sales revenue will be year one, which is 10,000 times this, right? This will be my sales revenue normally, right? But
Yeah.
I can decide to, because I want it in millions. Don't forget we're recording in millions, right? So I will divide it by 1 million. Do you understand?
Yeah.
Uh-huh. Because it's millions we're recording it. So this is millions now. And I can do that for all lines. I think we're clear. It's fine.
Yes. Yeah.
But
Yeah.
sharp, I can come here and bring in my sales revenue here. Sales revenue, right? Come here, plug it in. And to make your work neat, always state maybe it's working two or working one. I think this is working two because that TAD was the working one. This one was working one. This is working one. This is working two. All right. So let's move on. We do the same approach too for our cost and what and selling price. What I can just do here is I can copy all this guy here, right? So you can see the beauty of Excel. Normally, if it was local, you'd have this one even saves time than if it was writing. So I will do the same thing too, right? What I just need to do is, because this one is locked, I will drag this one. I will drag this guy. Which guy will I drag also? And I'll put this one here. I'll put this one here, right? I'll put this guy here. And I'll grow that for the rest. Is it clear?
Yes.
So the cost and selling amount is also using the what? The cost multiplied by the what?
Yeah.
It's even, I even have something. So what's this one? This should be this should be this should be 10,000, right? And the 51, yes, divided by that guy. So which is this? And I'll what? And I'll stretch it. So this is the what? This is the cost and what? And selling price volume, right? So we're going to what? We're going to take it what? Up. We'll just plug ASAP without what? Without wasting time. All right. So this production and selling. All right. So let's move on. What's the next one? They talked about there's one we've not touched. After
Development.
production. What do you say?
Training, training and development cost.
Yes, training and development costs. Don't also forget that special packaging that is in dollar.
Yeah. Yes, yes.
So this is the oneness. So how are we going to solve this one? We're going to grow it and convert it, right? We're going to grow it and what? And convert it. So, and they said for special package, was it was it was it growing by? Is it 10% or 5%? So they said it's 5% too. Can you see it? Look at that last paragraph. It is expected that the cost relating to production and sales of each batch will increase by 10%, but the selling price and special packaging costs will only increase by 5%. Can you see it?
Yes, 5%. Yeah.
So 5% rather. So we're going to grow this guy what by 5%. But don't also forget that as we're growing this guy, we need to what? We need to convert it to MP because it's
P.
in dollar. So
Yeah.
so how do we convert it to MP now? What did they give us as MP? What's MP?
That's today's rate.
Yes, was he exchanging at?
72 MP to
So he's
one
exchanging
dollar. Yeah.
72 MP to $1. So we have here MP to $1 exchange rate. Exchange rate. Exchange rate. Or let's just do it here. Exchange rate MP to $1 is what? Current. It's current. That's current, right?
Mm. That's year zero.
That's year zero. Let me bring it here. That's year zero. So it's trading at year zero. At zero is trading at It's trading at 70 what? Where is it? What did you call
Um,
it now? 72 now. Yeah, so it's trading at 72, right? If it's trading at 72, the question that we'll ask ourselves is that is that what the cost would remain at, Abby?
no, no,
Continuously.
no.
It's not possible now, Abby. So that means we're expecting them to give us information relating to either purchasing power or interest rate parity, Abby.
Yes.
Now let's move on. Let's see if they will give us something. So let's hold on to that one first. He told us what? Let's hold on to that one first. Let's do the other guy. They told us about the other guy, the training and development. If you remember, they say the training and development costs related to the production of the batches are estimated to be what? Are estimated to be 80% of the production and selling, right? Excluding the
Yeah.
cost of the special package. So we don't need to get the special packaging before solving the problem of the training and development, right? So in the training and development, year one, they told us will be 80%, while year two will be what? Will be 20%. So year one will be 80% of this guy, of this cost and selling, which is this guy. This is the
Yes.
volume, right?
Yes.
While year two will be 20% of the second guy. Are we clear?
Yes.
Mhm. Price. This cost of cost and selling of each price. This is what? This is total cost. So yes, so that's that. So we can just plug in that one ASAP without what? Without wasting our what? And they told us already that training and development, right? They said it will be new for the remaining years. So meaning that in year 3 to 5, right, it's going to be what? It's going to be new. So it's going to be new year. So I can come here. I can just quickly bring this guy ASAP. The training and what? And development. Training and development, right? That one is what? Workings 4 or workings 5, because I have not done the other guy. So I can come here, year one. Year one, this, and to go like that, because year two to pick it up to year 5. All those ones are 0. So that's about that. We solved that issue, right? There's still what? There's still one more that we've not solved, which is that what? The special packaging cost.
Yes.
Special packaging cost. So let's create a column for that one so that we'll not forget working 4, right? So we come down. Now, have they given us information? What's information? They said the current annual corporation tax rate in Megam is what? Is 25%. And Chumra what? Pays what?
20%.
It pays 20%. So it's Megan that we're concerned about. So it's Mega Zone that will come and plug in here. Right. Let's just be creating all the column for that. So taxation. We have what? 20 what? 25 what percent. So let's just leave that here first. 25%. So let's move on. And Chumraco pays annual corporation tax of what? 20% in the country where it is based. So both countries' taxes are what? Are payable in the year that the tax liability arrives. So meaning that if tax liability year applies in year one, you pay in what? In year one. So a bilateral tax treaty exists between the two countries, which permits offset of what? Of overseas tax against any tax liability Chumraco incurs on overseas earnings. So we've done that in that last question, right? We did that in one question recently, where by if you pay in the country where you invested in, you won't have to pay the what's remaining one. So if your own tax is higher than that country, you just pay the differential. So let's say, for instance, now they are paying 20% in the country where the in Megam where the this thing is situated, and they are paying 20%, and your own home country you are paying 25. So when they charge the 20% in that foreign country, you will just come and charge the remaining 5%, right? On
Yes.
your in your
Profit.
home. But if your own is lower, you will not you will leave it like that. Oh. There's nothing like refund. You're not refunding them. The government is not that nice. So let's move. So that's that about that. So now they've told us now that Now, the risk-adjusted cost of capital applicable to the project on dollar-based cash flow is 12%, right? Which is what considerably higher than the return on what short-dated short-dated treasury bills of what of 4%, right? The current rate of inflation in MEAM is 8%, and the country where Chumraco is based is 2%. Now the question is, what's the base inflation rate? We have base, we have S0, we have SB. Which one will be up, which one will be down?
The 8% will be up, 2% will be down.
Thank you. So meaning that we can quickly come and use our purchasing power to solve that one, that since we've gotten the information here. So where's that information down? So here now we can just come here. ASAP, this multiply by 1 plus 8%, right? Divided by 1 plus what? 2% here. So we have this, right? We have 76.24, and you can drag it right up. It should give us the rest. So, and automatically we can solve this one, right? So this one now, don't forget that it's growing by 200. So you have to be careful. 1 multiplied by number 1 plus this 5%, right? This 5%, I'm locking 669, which is the 5%. I'm also locking the 200 because it's growing, right? I'm locking this guy, right?
Okay.
What again am I locking? I'm locking, so no, so that's that. So raise to power this, guy, right? Having done that, we're converting, right?
Yeah.
I'll now convert to exchange rate. This is the exchange rate, right? I think that's all. If I'm not mistaken, I think that's all. So let's do that. So it will give me this. But don't forget that this amount, right? This amount, I'm supposed to convert it in. Wait, about dividing it by 1 million because everything is absolute. There's something we've not done. You didn't remind me. Don't forget that we're multiplying that thing by the batches. The $200 is per batch. Have you forgotten?
Okay.
So we'll multiply it by the volume also.
Okay.
We'll multiply by the volume. Multiply by the volume, which is this guy, right? So we have this, but don't forget that it's in millions, right? So we divide it by this guy, that 1 million. So that will give us here. So we can log this 1 million, right? So we have this, right? And we'll drag with the expectation that everything that we've logged are correct and the likes. So that is that. So I think we should be fine. So this one is 5%, 200, yes. 80, this is exchange rate. We didn't log the exchange rate, yes. The batch is 15,000 year two, raised to power year 2. So I think, and we logged the 1 million. So that's fine. So every other thing should be fine too. So we come here, we just bring the special packaging. We bring his own cost here. So we come here and we drag, right? So when we drag, the question is there any information that we are here to bring that we've not brought in to get our taxable profit? So they talked about the risk-adjusted cost of capital. We understand that the risk-adjusted cost of capital applicable to the project based on cash flow is 12%, which is considerably higher than the return on short-dated treasury bills. So normally for this kind of question, right, the risk, which cost of capital are we supposed to use? Is it the 12% or the 4%?
12%.
Thank you, because that's the specific risk, right? The project specific distance. So that's pretty straightforward. So now, what do we now do? So I think we've used all the information based on what they've given us. They now told us the other information. And as a Chumako Finance Director is of the opinion that there are many uncertainties surrounding the project, as assets that the cash flow can vary by a standard deviation of as much as 35%. Can you see? As much as 35, that's standard deviation. So this is an option information. So S, they've told us already is 35%. They now told us that recently Bulutco offered Chumako the option to sell the entire. So this selling now, right? Sell the entire project to Bullet Co. Right now, selling the entire project, is it a delay option? Is it an abandonment option? Is it an expansion option? What option is that? That's an example of what?
Abandonment.
Thank you. So you're abandoning your project what to sell, right? And the price offered is what? 28 million. What does that suggest to you? The price offered, that's the what? That's the PE. Exercise what? Exercise price, right? So what do I need to do? But we've not gotten to that part. We don't need that one yet. Let's finish up on our NPV, because that's another option, right? Those are the information remaining. So what we just need to do is what? Get our taxable profits from all these things that we've done up. So taxable profit, whether it's a profit, whether it's a loss, we'll know. So we'll come here. We add up, right? So this will give us this. This will give us this, right? So me, like I told you, if you don't have, normally what I would have done is I will use this sign, right? I'll use this top to show, indicate. But in the exam only, we don't have this opportunity. What you just need to do is just bold it, right? To show that this is your taxable profit and loss, right? So now I do my tax, right? What's my taxation? Is here already. So let me just cut this and bring it there. That's a bit of Excel.
Okay.
So I come here, right? This one is what? 25%, right? Multiplied by all of this. I lock my C18, which is my tax, because it's a constant, right? And what? I drag. When I drag, what do I need to do? I can then add back my non-cash item, right? Add back depreciation, right? I add back depreciation. I'm adding back depreciation is what? Is bringing this guy here, but in positive now, right? I bring him here. Right? I take off the board. What next do I need to do? I cannot get my cash flow now, right? I cannot get my cash flow, right? My free cash flow. So what's my free cash flow? My credit is addition of everything, right? So I come here, the three of them. I bring it. I use I use this and I bold it. What's on this guy? So I come here. This is my free what? This is my free cash flow.
What about the working capital? Okay, it's done. Okay.
This is your working capital, yeah.
Okay.
Oh, sorry. This is normal cash flow after tax. This is not your free cash flow. This is normal cash flow. Your cash inflow. These are cash inflow. Or anywhere you want to put it, or cash flow, anyone. So just leave it on cash flow. It's not inflow, because they see inflow down too with the sales of the machinery. So we have these guys, right? So or you can say cash flow after taxation. Just put cash flow after taxation, because that's the cash flow you got after taxation. So you now come here. So this is your final what? This is your final what? Cash flow after your working capital and the initial what? Investment. So is your cash flow. So I come here, right? Addition of all of this. One sec, please. Let me charge my system. So, all right. So addition of these guys, right? So, so I have it like this, right? Hello.
Yeah.
So at least we've been managing ourselves this way with this
Okay.
network. All right. So I okay, so I talked about the cash flow, right? And I added all. But there's something we did not that we missed, right? Don't forget that
Okay.
when we're adding back the depreciation, right? We added this depreciation for the 5 years, but we forgot to include the balancing allowance also. Don't forget that the balancing allowance, that additional 125 that we made in the balancing allowance, is a non-cash item. We are supposed to add it back.
Mm.
Can
Yeah.
you understand? So we'll add this guy to back. So it will be at year 5. So we can add it together with that year 5 zone, right? So uh, so I think it's looking fine now. I had to just review that when that network was breaking to check for my errors. All right, so that's that about that. I think so. I don't think we missed anything. We can just check for correction to see if there's any other thing again. I think all this one we added it correctly. Yeah. So all these ones we did it correctly. All these ones we did it correctly. Yeah. So I think that's that. So and if there's anything we miss when you are reviewing, you can prompt my attention to it.
Okay.
But so far so good. I think we've been able to capture everything we are meant to capture. All right. So this cash flow, right? This cash flow. But now let's look at something. Because of this, because of these different currencies, did we even bother to check the country that was investing, right? Which country are they?
US.
Do you understand? So
Yeah.
you you agree with me that the country that invested, they're not actually they're not actually in this thing. They're not in mega because they want to invest in mega, and
Yes.
from that we can deduce that the currency will be dollar. Do you understand?
Yes. Yes.
Because why? The other currency that we have is only dollar. They told us about dollar. The special this thing that they will be using is dollar, meaning that that's from the home country. They now told us that there's someone that wants to buy the product, the investment from them for $28 million. That should tell you that that means the group company, right? The owner of those investments, they are actually situated in a country where dollar is the what? Dollar is the currency. And if dollar is the currency, what do we need to do? If they want to repatriate their money, they will repatriate in dollar. Abi?
Yes. All that.
So so this question we solved actually solves so many things for us. It's so the advanced investment appraiser is also associated with foreign operations, right? And is associated with what, with options. So we've done three in one again. So this is another foreign operation question that I've just stylishly solved for you again. So there's no how you will not be good on that one. And if you remember, the first foreign operation question we solved, though that one is more detailed than this one, but you agree with me that that one they gave us the forward rate for those countries. This one we had to solve it ourselves. Do you remember?
Yes.
This one we solved it ourselves. Even that one self, even though they gave us, we were able to derive it ourselves to show that, oh, we know how they arrived at those numbers they give us by using what, purchasing power, what, power parity, right? So let's move on. So we now move to the home country. Now the home country is what, the home country is what, in dollars, right? In dollars. So and don't forget that this year zero, as we have it, and it goes like that to year five, right? I make it general. All right, hold it to make my work neat, though under exam condition. Don't go and be thinking of all these ones. All right, so it's when you are done and you now want to start designing a hair. And God helping us, we've gotten the exchange rate which we use for that dollar this thing. So we can just come here and quickly apply that. This is it that we got down here, right? In one workings. You can call down maybe whether working, any working you want to call, any working you want to call it. So let me put workings. Which one have we not used? We've used five. Let's just say working six, right? So exchange rate. What's wrong with this my system? Exchange rate working six, right? So that's that about working. We now convert all this value that we've gotten in that currency. We convert it to what? We convert it to dollars. We convert it to dollars. So these are the cash flow in this new currency now. Will be this divided by this. I told you, depending on how the currency is, right? Which one is the base and the this thing. Don't always think it's divide. Oh. It's not every time that it's divide. Oh. Please let your eyes shine. Oh. It's not everything that is divide. Oh. Don't go and cram it. Oh. I'm begging you. I'm begging you. So that's that about that. Depending on how the currency is or how they place the currency. I've solved a past question before like that we're meant to multiply, but because me, I'm always carrying the knowledge of divide, divide, divide. So I divided, whereas I missed it. Whereas based on the way the currency was placed, you are supposed to multiply. So always shine your eyes to know whether it's divide or what, or multiply. Thank God this guy has done a lot on risk management for you. So I don't expect you to make those mistakes. And most times, if you remember, there's one mistake that we used to make. If you solve netting question very well, if
Mm.
you solve netting question, sometimes that thing people make that mistake a lot on which one we are supposed to multiply or which one we are supposed to divide. So please, as the spirit of the Lord is leading me in netting question, if they give you a netting question, know when to multiply, know when to divide. Oh, I've given you one. I've given you one. This, All right. So, what is the discount factor, my sister? And don't forget
Okay.
our discount factor. We agreed that is what? It's
12%.
12%. So 12%. What do I need to do? I just do my one plus is 12%. 12% locked. Is 12% locked. Um, raised to power. Raised to power this, right? I think it's minus. I have this guy, and I come here, right? When I have this and I multiply to get what? The present value. The net present value, NPV, net present value. So I do this. So having done that, now I now need to get whether it is a what? whether it is to accept, or whether it is what, whether to reject this one. I use double I use double border for this one, top and bottom. Yep, to make my work neat. So I come here. This is the present. So this is the present value. Now the net present value is the addition of everything. Net present value. So my net present value will be this summation of this. So is this net present value? Is it in dollar or in Megan?
In dollar.
So it's in dollar. So I make it dollar. From this, is the project viable or is not viable?
It's not viable marginally.
Hmm. This woman and English is not viable. It's not viable marginally. Okay. Oh. It's not viable marginally. Oh. So they said, so we've been
Like
able to answer that 40. Eh?
what I'm what I'm saying is if they do more sensitivity analysis, it will be viable.
Oh,
Because
oh,
different,
you are very smart. But don't forget that that sensitivity analysis, right? That's using best case scenario, Abi.
yes. Because
But don't forget that I said,
the
okay,
difference
I'm
is
with you.
very small. Because if you notice the amount are in
Mm,
millions,
you're right. You're
but
right.
the difference
It's
is
very.
quite like very minute. So you
Thank you.
could just maybe I could just say that sensitivity analysis.
Until hold on before you continue the saying. First thing, because the project's MPV is negative, the
It,
project should be rejected. That's the first thing. You cannot
okay.
continue the grammar you are blowing now that though further analysis can be done, like performing sensitivity analysis on best case scenario to see what the project what viability, right? That's using sensitivity analysis on what reassessing the assumptions and using the base case scenarios to arrive at a positive MPV if that case is. But what is the answer first? Reject because it's a negative
Reject.
what?
Yeah.
A negative NPV. So
MPV.
that's what that's that about that. Oh, now that's 14 marks that we've solved. Now the 5 marks question now. They now said an estimate of the value of the project taking into what account taking into account Bulu's what co-offer. And in that Bulu's co-offer, they told us that recently Bulu co-offered Kumako the option to sell the entire project to Bulu Co for what $28 million at the start of what? At the start of year 3. So what's your time to maturity? T is what? Time to expiry.
That should be 2 years, right? Before year
Why should it be
three.
2 years?
Because you
Why
said
should it be two
is
years?
according to what you said is
Yes.
years before the maturity. Before
Thank you.
exercising the right. I'm
Thank
not
you.
sure if I'm
Thank you. And you
correct.
know, you are right. And don't forget, they said at the start of year 3. So if at the start of year 3, so you are using only year 1 and year 2. Let's say at the end
So
of year
okay.
3, right? It
Mm,
will be 3 years. If it's at the end of year 3, because year 3 has already been
okay.
factored in. But you're using start of year 3, so it's just the beginning of the year. So the 2 years that you have to make that decision is year 1 and year 2. Do you understand?
Okay, yeah.
Mm. You see now, thank God. She said, thank God I did not say rubbish. She said, what you said. What you said is not what we saw in the slide. What you said. That's us. Thank God that someone did not say rubbish. Because on the exam day, they will say what you said, what Shegu said. All right. So, God, please help me to continue saying the right thing, because these students, they can swear for someone. What you said. All right. So, let's move on. Now, so I told you that we need to get 5 variables, Abby. So we've seen that
Yes.
what this is an option question. So let's sharp, let us waste time. They said present value of the what of the underlying asset. Now, under abandonment, what are we supposed to use? How do we get the PA?
That should be from year 3 to year 5.
Year 3 to year 5. Why is it year 3 to year 5?
because the to abandon the project start from the beginning of year 3.
All right. So that means we're using the dollar present value year 3 to what? So
Year
year
5.
5, right?
Yes.
So it's dollar also. So the exercise price. The exercise price will be what? Which is the what? That's the price
The
offered, Abi.
yes, 28 million.
So which is P, which is P. So that will be 28 what? $28 million, right?
Yes.
We need T. We already established time. Time is T, Abi, which is what?
Yes, that
How many years?
2 years.
2. So these two, right? What again? We
Mhm.
need standard deviation, Abi.
Yes.
So we need the annualized standard deviation,
The
which is
first
also the
person.
volatility, which is also known as the volatility
Yes.
of underlying assets. And that one, they told us already that is what? 35%, Abi.
Yes.
And the last one, we need what? The risk what? The risk-free
3.
rate. You can see why they gave us that risk-free rate in that project work. They just wanted to use that one to distract you. Whereas the main reason why they are giving you that risk-free rate is because of this guy. So whoever is not smart, you're not going you go and use 4%, the short-dated treasury bills to be discounting the cash flows. You're on your own. This is the main reason why they give you that information. This is the standard variation. This is the risk-free rate R. So we've gotten the 5 variables. So normally, like I said before, if it was the former way, we would have used Black-Scholes model to solve that manually, right? Using all that formula. But thanking God for ACCA, they said there's no need for all those rubbish again. Or no, not rubbish. I take my words, for all those stress anymore. There's no need for that stress, right? For that stress, you don't need to go through stress because you guys are sophisticated investors. You pay in pounds. You pay in pounds, so we don't want to stress you. Do you understand? Let's say you were paying naira, maybe we would have stressed you, but you pay pounds, so we have to treat you like specially, right? The way you are. So now, before I forget, is it a call option or a put option?
That should be put.
So
Abandonment
whatever
put.
that, yeah. So net present value of the project with put option. All right. So I come here. I go to my BSOP calculator, like I told you earlier. Right. I go to my BSOP calculator, which is on my screen here. Confirm you can see my screen, please. So what is my PA? My PA is 30.62, right? My strike price is what? 28. My time to maturity is 2, right? My dividend yield, nothing. So I put 0, right? My volatility is what? Is 35%. So it's already in percentage. And my risk free is what? My risk free is 4%. This one I just saw it online, so because I couldn't have access. So I have here our call is what? Our call is 8.22 and our put is what? Is 3.4. Now my question is, which one am I picking? Is it the put or the call? Is it put, Abi?
Put, yeah.
So I don't waste my time. I just take my 3.45, right? If you are using your own BSOP to give you the accurate information, right? Because this one is online. So, but it should not be far from what you will use when you use your BSOP. You can try your BSOP from your own end. So now if I exercise that option, now you can see now that normally if I don't exercise that option and I allow the project run for 5 years, I will make a loss of 0.44 as we have it up there. But if immediately I'm smart and I exercise that option in year 3, it means that I will get my put option when I sell, I will gain what 3 million what $3 million as we have it here, $3.5 million. What will now be my net present value with put option, right? So this is the put option. No, sorry. Let me copy this. I need this information. This is the put option. I would have added it together, but let me break it down so that I will not, whoever is using this would. So this net present with put option will not be this put option, which is 3.45 plus the 0 what? The 0.44. Meaning that if I what? If I sell it, this is what I will what? This is what I will what? This is what I will get. So
Okay.
now the question is it to exercise the put option or to leave the project?
Exercise the put option because it will
So it's
increase. Yeah.
yes. So is to exercise what? The put option. So that's that about the question. Let me go back to the question, right? Now they now said the last part, a discussion of the what? Of the assumption above and the additional business risks which Umrako should consider before it makes the final decision whether or not to undertake the project. We've talked a lot about the assumption. We've done something like that before, so it's not something I need to be explaining to you. You yourself, you mentioned it. You queried the why the cost this thing is higher, is growing by 10%. I think there's one you also queried too. You queried the, which one was that again?
Working capital.
You query the working capital. So those are how you'll be querying everything. You can query you can query the work. That is it project specific? Is it blah blah blah, right? You query that too. That did the financing structure change? If the financing structure change, did they factor it? The business risks too would have changed by expansion. Did they factor it? So those are things you just talk about and you just fill it up. Now this thing is 14 marks. If I were you, the best thing is to what? Give what? You can see that one, a discussion of the assumption made in what? In part one. So you talk about what? Assumptions about the first one, which is I. You now talk about assumptions for the second one, which is the option, this thing. If I were you, you can talk about the limitation of BSOP. Those
Okay.
limitations that I told you, you understand, and that assumption, you play around that, right? Play around that assumption and limitation that BSOP was designed in a perfect market system. Here we have it is not a perfect market system. Do you understand? So you might not be able to apply it, right? So you play around that assumption and limitation as I explained to you for BSOP. Those are what you use to tackle the assumptions in part two, while in part one. So if they're telling you 14 marks, if I were you, meaning that I must write a point 7 marks for the part one and 7 marks for the part two. So if I'm talking about 7 marks for the part one, meaning that the minimum conversation on the assumption I should talk about is minimum of 5. To be able to give them 5 solid points. Do you
Okay.
understand? And if God give you the grace, give them 7 so that they will give you one point for 7 marks. Do you understand? You can 7 marks is even easy to get from this place. One point. You can query the sales revenue. You can query the work. You can query the working capital. You can even query the land and building that they say 80% value that you will get back. Normally, what we know that is land and building is supposed to be appreciating. Abi?
Yes. Appreciating. Yes. Yes.
Thank you. Land and building is meant to be appreciating, but yeah, is depreciating. You can
Yeah.
query that. You can see how beautiful that point is. That point is very distinct. Normally, land and building should appreciate. So you can query those things, you play around those things and get your 7 marks. And the assumptions of BSOP, you also what? You also use that to get the what? The second one. So I think that's fine about that. Any comments, any question before we call it a day?
Um, it's actually an interesting case. The
Yeah.
only confusion I will maybe I will just have to is just years, because when I'm doing this calculation, I always miss the years
Mm.
up. Based on what you've
When you
explained now, all the years
okay,
abandonment
okay.
and delay is before um it is prior to when the option will be exercised, any option whatsoever will be
Yes,
exercised.
yes,
So that's
yes.
actually fun, because that was what I was able to now understand from like gave you your answer. So
Mm,
that's that. And
mm.
so PA, I feel the PA for everything should be like after the option should be those cash flow, present value of cash flow after each of those
No,
options
no,
should
no. That should only be for abandonment or after. Delay.
um
Delay. Delay is different. Delay is that I'm delaying this project. So delay would be all the cash flow up to the delay point. Do you understand?
Okay,
Not
like prior,
after. That's for
prior.
delay.
Okay.
Do you understand?
Let me
Let's go back to that slide. Look at the slide.
let me write it.
Look at the slide. The slide says delay. Look at delay. Present
Mm,
value of project free cash flow discount at project or company work. So you are using all the present value of the project cash flow, right? Because you are delaying it. You are delaying it. So the project is the cash flow of the project up to the delay point.
okay, up
Do you
to the so
understand? Yes.
all all present value. So is it applicable to both delay and expansion?
Most likely, yes, because they are almost call options together. So yes, present value of additional cash flow generated. So you can see this one. Present value of addition. No, it's not the same.
It's
Additional cash flow. Do you
wahala.
understand? So whatever cash flow you start generating from the expansion, the cash flow the expansion is giving you. So normally when you expand, right, there's a cash flow that the current operation is giving you, right? That is not what you include, right? Even
Mm,
post the expansion is the cash flow, the additional that is generated from the expansion. Do you understand me?
okay.
So let's say for instance now, the current the current operation is generating a cash flow from year 1 to year 5. Just note that, right? Let's say you now expand in year 3, right? And
Okay.
from that expansion, additional cash flow is maybe 20 million from year 3 to year 5. You are not going to
Okay.
use you are not going to use 20 million plus the current operation cash flow. You are only going to use 20 million that was generated from year 3 due to the expansion. Do you
So you
understand?
you mean present value of that 20 million?
Yes, for let's say the 20 million is for 3 years. 20 million year 3, year 4, year 5. Is that 20 million year 3, year 4, year 5? Their present value discounted. That is what you are going to use. Do you understand now?
Okay, I understand.
So,
Gosh.
so you have to be careful with the PA. The PA is very important, and the PE in
Okay.
the for the three of them. So, are we fine?
Yes.
All right. So, have a wonderful night. If God give me the grace, I want us
What
to.
next plan?
What do you say?
What's the next plan? What's the next agenda?
She said, "What's the next agenda?" Oh,
No, I
so
mean, when are we meeting, I beg?
let's meet. Is tomorrow okay by you?